Good morning, everybody. Welcome to the Reserve Bank and to our October official cash rate review. The Reserve Bank this morning is cutting the official cash rate by 100 basis points. That is, we're reducing the official cash rate from 7.5% to 6.5%. The main reasons for this are the ongoing degree of international financial market turbulence and the fact that we are now seeing some deterioration in international growth outlooks. Compared to our forecast in the September monetary policy statement, we do see New Zealand's economic activity now as being more constrained. We are seeing reduced demand for exports. We are seeing restrictions on credit in the economy, and we're already seeing more cautious consumers and businesses, and in some cases we're seeing them start to curtail spending. But this isn't all bad news. It has been partly offset by some other factors. We're talking here about the fact that the New Zealand dollar has fallen, helping cushion some of these effects. We've seen a marked reduction, of course, in the oil price, and there's been a recent loosening in fiscal policy which has assisted as well. The weaker growth prospects and the fall in the oil price now mean that we expect to see the consumer price index tracking back into its 1 to 3% target zone by the middle of next year. Nevertheless, we still remain concerned by some residual high domestic inflation pressures, talking in particular about residual labour cost pressures and some other areas such as local authority rates, electricity prices, and even some remaining strong construction costs. Well, we're going to stay focused on that medium-term inflation outlook. If inflation falls as we now expect, then we will have room to cut the official cash rate further. However, the timing and extent of any further cuts is going to depend on some real evidence of a fall away in domestic cost pressures, and also, of course, on us tracking and seeing and having some understanding of how global financial markets are playing out. Thank you, ladies and gentlemen. We're open to questions to assist. I've got Dr. John McDermott, our Chief Economist, and Tim Hampton, Head of our forecasting team. Any questions?
The outlook for exports and credit, obviously it's worse than it was for the pre-FU. What does that mean against the backdrop of an election campaign?
Well, we wouldn't comment on any political consequences of any of this. I think there's a broad understanding of the fact that the world economy has moved and that we've seen that financial turbulence there now starting to come through into real economic forecasts around the world, and we're, of course, not immune from any of that. So some of that will feed through into export prices. Having said that, we're still receiving, by historical standards, reasonable export returns in many sectors, and in addition, the softer New Zealand dollar has meant that New Zealand exporters are getting the benefit of that.
Dr. Pollard, you say you expect credit to be less readily available. Apropos of that, can you update us on clear discussions about a guarantee for banks' wholesale funding?
Well, on that, officials are continuing to do work, and that'll be up to the Minister to take any decisions and make any announcements around that.
Close to an announcement, would you say?
Officials are working on possible design issues.
How quickly would you expect banks to respond in terms of mortgage interest rates
to this cut? We'd expect to see some response. Of course, it's a little bit complicated at the minute because the cost of funds has pushed up significantly. In addition, over the last few weeks, we've seen some quite different responses by different banks to cuts that they thought might be in the pipeline. Some have already responded, some haven't. So I think it's a bit hard to generalise, but we'd certainly expect to see some impact of this coming through onto mortgage rates.
Would you expect all points to be passed through, either done in advance or afterwards?
Just answered that one, Bernard. It's quite complicated.
Dr. Bollard, can you tell us when you now expect New Zealand economies to come out of recession?
Yeah, well, you need to understand, Simon, that we don't, for the official cash rate, do a full forecast. What we have done, though, is we've had a chance to look through at how our September picture might have changed. You'll recall, of course, a couple of weeks ago, a number of central banks cut rates significantly off the back, I think, of more concerns about financial markets. We declined to move at that stage. No doubt your grandmother told you about acting in haste and repenting at leisure, and we have had the chance, in contrast to some of them, to now go through and look at our forecasts, and we do get a picture of a softer story there, but it's not a historically poor economic story by any means. And now, sorry, your original question was
when I think the September forecast had you coming out of recession about mid or the end of this year, I think. And I'm just wondering, given that you're now seeing a lower growth outlook.
Well, we wouldn't be too specific, but we do see a bit more softness, and we see a flattish economy for a while, but not necessarily a economy that continues in recession. I think it's more about speed of pick-up out of that. It is a little bit hard to pick the New Zealand economy at the minute, in that we've gone through a slightly earlier cycle than some of, say, European or North American countries. And in addition, of course, we took the advantage to move earlier than many other central banks as well. We started cutting in July. Now, some of that effect's come through. In addition, we've had the advantage of the New Zealand dollar coming down and insulating some of those effects. In addition, there's been softer fiscal policy. Those things have all started to have some effect, but nevertheless, we do see a very slow pickup out of the current recessionary conditions.
Well, let's put it this way. Treasury, I think, forecast that the economy would barely grow till the middle of next year, and their forecasts were done sort of, I think, in mid-August or something like that. Would you say that those are now overly optimistic?
Oh, not necessarily. There's been a lot of other changes since then, such as the New Zealand dollar coming off more than they had, oil prices coming off a lot more than they had. So there's some cushioning features as well. But having said that, the world economy looks worse than when they had to cut off on their forecast.
The New Zealand dollar you mentioned a couple of times there. At what point does that start importing inflation?
Well, when it drops, it starts importing inflation. If you mean at what stage do we start getting worried about that, it's not. We don't think it's the driver that we have to worry about right at the moment.
Dr. Bollard, in terms of credit availability, there's lots of anecdotal reports of commercial enterprises finding it difficult to get loans not being advanced when they previously had been agreed, and those sorts of things. Are you concerned about the lack of credit to New Zealand's corporates from the foreign-owned banks, essentially?
Well, you'll see our picture on financial stability when we come out on November the 12th with our regular financial stability report. In the meantime, we do focus on the extent to which credit restriction might slow growth, and certainly because of higher rates and high international funding costs and fragility of international funding, we're already seeing an impact through onto business investment. So it is harder for businesses to borrow, and that does have an effect through on the real economy.